Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Joe Clark, Managing Partner. Thankful for him to join us this week. It's always good to have him on every few weeks. And we appreciate those of you that came out and visit us at the Thirdly and got a chance to see us online. And we'll wrap up with a word or two about that. So this week, we're going to talk about a few things. We're going to take a look back. I know the past rolling in 3 and 5 years are an important part of reviewing the statements and so forth. So we're going to take a look back at a rolling 5-year window. We're going to take a look then at this year. And then Joe's going to touch on international markets and give you a breakdown there. So let's dive right into what has really been a rough 5 years when you look at it over the past 5 years. Now, one thing I'll take you back is if we go back 5 years in time, several of you came in and may have begin to initiate a distribution phase, begin a withdrawal rate. You'll recall we kind of guided those percentages lower simply because interest rates at that point in time were still around 0 or 1 and would remain there for the next year or two. And so part of this 5-year period is accommodating and realizing that interest rates were so low, negligible basically in many cases, and we had to adjust it and move north. So the S&P 500 had a pretty decent run. Pushing 10%, the equal weight, which we talked a lot about in the Thirdly, a little bit less than that. So decent and respectable returns there for our large U.S. companies, but that's really the end of the story. And as you know, a diversified portfolio requires much more than just those 500 stocks to truly get you through multiple market cycles, which is what our job is to do on your behalf. But if you look at global stocks, that's the symbol EFA, that's the blue, and that's the middle. And these are with dividends, by the way. So 3.3%, not a whole lot to speak of. And our domestic, that's the Russell 2000. So those are the 2,000 of the smallest stocks here in the U.S. at 2.4. The thing to highlight, though, is over a rolling full 5-year period. If we were to update this on what we have seen so far on Monday and Tuesday of this week as we're recording, that 0.1% that's been realized on bonds is basically gone and would be negative over a whole 5-year period. So that's really what we're dealing with and what that has implications for, even for those of you who've been with us a long time, whether you're in a balanced or you have a diversified portfolio. We got used to seeing 6, 7, or even 8% on an annualized basis. Those have come down largely because of the fruit that we've seen of this harvest in our investment orchard. Now, the good news is, looking out through the windshield as opposed to the rear view, we get to start with higher interest rates, dramatically higher if you want to put it that way. And we're clipping 6, 7, 8% yields in some places, and that's a much better outlook going forward. We talk a lot about interest rates as setting the table. That's because all investments, whether you're stocks or real estate, really peg themselves to interest rates. So that's the good news that I'll share after having reviewed that. And I'm going to pass it over to Joe and really look at and break down this year in a couple of different ways.
Yeah, folks, it's been real interesting to be able to watch what's happened inside of the marketplace. As a spectator, I'm not in the day-to-day portfolio decisions like I once was, and so it's easy to watch, especially being one of you guys going, hey, what in the world is going on with this marketplace? But you really have a story of a history tending or trying to repeat itself to a degree, if you will, as we look back at the 1998, 1999 era. Those are an important period of time for me because it's when we started the Financial Enhancement Group back in 1997. And I watched companies that had very strong discipline in their investment management process. And then I watched companies that didn't. And going into Y2K, the largest event that never happened, the S&P 500, 40% of the value of that critter was made up by technology and telecommunications that had negative net earnings. In other words, they were still talking about a burn rate. And it was just a fascinating period of time watching how long it took for the S&P 500 to get back to positive returns was really phenomenal. Unless you didn't participate in the technology and the telecommunications that drove it up. And that's really one of the smart plays or the disciplined approaches to looking at where we are in the marketplace right now is staying out of the headwind of some of those very large companies that they don't have negative net earnings. It's not like 2000 in that respect, but they're just making up such a large share of the S&P 500. And there's companies with much lower multiples that are doing a great job. We're looking all over in those areas to find all what we would call perhaps alternative investments. One of the common questions that we get is about gold. And if you look inside of the middle of this chart on year-to-date asset returns, if we looked at a history book, if you will, and what people's expectations would be with potentially higher inflation and certainly higher interest rates, a lot of people would say, well, gold must have had a very good year and must be a place to go. And if you look at that chart, you'll find it right in the middle. Oil has actually done the best year to date, crude oil, if you will. The S&P 500, the index that we talk about, the mega caps have done the best. Small caps and gold are right in the middle, and at the very, very bottom, still shocking to a lot of retirees and investors, is that emphasis of what Adam was talking about. The aggregate bond index over a 5-year period of time is not just negligible, in all fairness, is likely negative. Now, the next chart that we're going to show you is really where we are when we look at the world global stock market. We got to ask a great question at the third leg, was what is the difference between the U.S. economic market and the global stock market? And I want to break that into two areas. As you know, one of our rules always has been the economy and the market are two different things. That's true domestically, it's true internationally. But when you look at this chart, you get an idea, a sense of where we are economically. The U.S. still represents about 20-some%, if you will, when we look at some areas. But when we look at the U.S. stock market, we're about 42% of the value of the multiple trillion-dollar market, obviously. 42, almost 43% of that market is the U.S. Then you have China, then you have the EU, and so forth. If you weren't at the third lane, we had more than 200 families in attendance. You missed the part where I shared that Canada is now, and probably will be for a long time, our largest trading partner. But there's been a shift from Mexico from China rather, back to Mexico as being our number one emerging market trade partner. First time since 2003. So economically, there are some shifts that are certainly taking place. But that is true inside of the market. Unlike the Ryder Cup, sadly enough, the United States dominates clearly what's going on inside of the stock market, at least right now. And when we talk about that diversification, the portfolios are designed to be able to look at the top performing sectors, the best companies relative to their peers, to try to keep you in the midst of a diversified portfolio. And Adam held out one of the best things, and in a balanced model, in a balanced portfolio, history bodes very well for where we are right now. That does not necessarily say that everything is going to be rosy. When you look at seasonality, we are in one of the worst weeks inside of the marketplace. And as Andrew probably shared with you a few weeks ago in the Market Carver, seasonality has been just right on track in terms of how the market has performed this year. There seems to be some good light at the end of the tunnel as we watch some of this stuff get washed away, but it is a very, very interesting time. Like I said, if you haven't seen the third link, the video link is there. It's in all of our emails for you to be able to click on and watch. We've had over 100 people watch it online. I think it's very, very helpful, and Adam did one of the best presentations of all times for an FEG third link. In the meantime, if you got any questions or any comments, we are more than happy to take those. Look forward to seeing you in the office for your family update as the tax planning journey begins here as we begin to wrap up the end of the year. Have a great Thanksgiving, my friends, and I look forward to seeing you again soon.